The US dollar has outperformed most of its peers to start 2024. So we're going to go through the factors that's driven the US dollar's resurgence, whether that can continue. And of course, we'll take a look at the charts, this time at the Euro USD. The US dollar has outperformed its G10 counterparts to start the year, really driven by resilient US economic data, as well as pushback from US Federal Reserve officials of imminent interest rate cuts. Now, when you do look at the data, we're seeing very strong signs in the labour market, above trend GDP growth, along with signs that the household sector remains very strong as well, with consumer spending remaining elevated. Now, we had the first Fed decision for the year just a couple of weeks ago. And although the Fed flagged that it expects at some stage to lower rates this year, the prospect of a March rate cut is unlikely. That's to use the exact phrase from Fed Chair Jerome Powell, causing the markets to really reevaluate the path forward for the federal funds rate, deferring when that first cut will arrive and winding back the number of expected cuts to come this year as well. And again, it's all being fleshed out in the data that perhaps the US economy doesn't require any kind of easier policy to try and execute this soft landing, at least for now. The Fed has said that it is willing to lower rates in line with inflation to keep policy in real terms unchanged and in a sufficiently restrictive territory. But for the time being, there are just signs still that the US economy is outperforming its developed market peers, and this is really feeding into the strong US dollar. Let's visualize some of this now, and here are some charts just to give you a picture of what's happening in terms of rates markets and then subsequently the US dollar as well. You can see here, this is the implied path forward, sourced this information from Bloomberg, of course, in terms of what Fed funds futures are pointing to in regards to future policy. And the odds of a rate cut in March have diminished significantly down to, well, as of the end of trade on the 12th of February, around 17% or so. And the number of cuts baked in before the end of the year, you can see there on your screen there too, is a little over 4. We'll call it 4.5, but it's a little closer to 4, the implied probabilities of the number of cuts this year as well. And if we move along, you can see the sort of change in the shape of the Fed futures curve over the last month or so. This is comparing the curve to the middle of January to the start of the week we're having. And you can see a significant steepening in terms of the curve there, and about 60 basis points of cuts that have come out of the market. Now, this is incredibly significant, and it comes in response to some really robust data. The right-hand side, you can see here, sourced from Bloomberg and produced by Citi, is the Economic Surprise Index, the US Economic Surprise Index. And you can see since the middle of January, we've seen pretty meaningful upside surprises to US economic data. And then on the left-hand side of your screen is a nowcast produced by the Atlanta Fed, which gives a bit of an impression on where the quarter's GDP could land. And after some really strong prints for the last quarter, that were somewhere around 5%, a little bit lower than 5% growth, well above trend, you can see that there is nothing stopping, at least based on current forward-looking indicators, the US economy's growth trajectory. And again, you would have to say our performance too. So the Atlanta Fed GDP nowcast currently suggesting that Q1 GDP should be somewhere around 3.4% or thereabouts. And you can see here in terms of spreads between German Bund yields and US Treasury yields, a significant widening of the yield differential in favor of the greenback and a subsequent depreciation in the Euro USD, which we'll look at now when it comes to the technicals. So here we have the technical setup for the Euro USD at the moment, and you can see with the resurgent US dollar and that resilient US economic growth story, a short-term downtrend emerging for the pair. Buyers defending that 107.50 level, but if that breaks, you have to say that 106.50 is the next key level to watch on the downside. We are in something of a trend channel, so to get a real sense that there's a reversal of foot, would probably need to see a break of that downtrend, and then also a push back towards the 200-day moving average. Price is currently below that, which does signal, generally speaking, a slightly more bearish market, and that's being indicated on the daily RSI as well, which is showing bearish momentum. A couple of key levels to watch on the upside: 108, perhaps some level of tentative resistance there. Sellers entered the market in the most recent wave higher within this short-term downtrend for the pair. But if that happens to break through, or you start to look towards that kind of 109 level where the 200-day moving average is, assuming that we can break through and break out, I should say, of that short-term downtrend. So that's what's driving the US dollar at the moment, the outperformance of the US economy and the unwinding of interest rate cut expectations in the US. One would suggest that it will be those data points, consumer spending data, the labor market data, GDP figures, and of course those inflation figures as well, that will determine whether we'll continue to see this US dollar strength come through by virtue of a further pricing out of rate cut expectations, or whether things might finally start to turn around a little bit. For the Euro USD, it will probably be the most important determinant of trends from here.